experts saying that the earnings for the Indian companies might get impacted for the next 2 quarters at least. So do you see that happening?
It will happen. We've seen a global financial crisis, we've seen an Asian currency crisis, we've seen a COVID crisis, now we are seeing a Middle Eastern crisis. So in some sense, this is a little bit of an opportunity.
But one thing is changing in the Indian landscape right now is the contribution of the IT sector in the overall index performance.
The early indications are AI will result in an increase in the total addressable market for Indian companies. The question which is harder to answer is what will be the longer term impact.
Why do Indian markets trade at generally at a higher P multiple than some other market?
So I think there are 2-3 reasons.
There's some investors who is investing, say for example, 1 lakh rupee in the fund right now. Kind of allocation should you do?
Besides SIPs, which should continue, one can now begin to look at lump sums as well.
Some sector or some industry has played out very well after you selected it. So how do you exit?
So one is price-based selling, when our target prices have been achieved. The second is we aim to sell when things go wrong.
This is the time and I should be switching to this sector or maybe this industry or this particular stock. What kind of process do you follow? Why do Indian markets trade at generally at a higher P multiple than a Chinese market for that matter, or maybe some other market?
So I think there are 2-3 reasons. One is India is a much more diversified market compared to a lot of other markets like Brazil, etc. Those are commodity heavy markets. So when you are less of a commodity market and you're more diversified, you tend to trade at higher multiples. Commodity companies also tend to trade much cheaper, and hence that's one reason for the premium. The second is India's ROE has certainly been higher than emerging markets, and that I think justifies some premium. And I think thirdly, the long-term secular growth, not only for the economy but for companies also, is also fairly robust, considering that GDP growth is 6-7% and inflation is 3-4%. So overall economy is growing at 10-11%. So I think higher growth, higher ROEs, a more diversified market, I think all of these stand out. And of course, I think we have incredible management in India, and that gives people confidence in the India story and Indian companies as well. So I think a combination of these 4 factors has always resulted, not only for the last few years, but for many years, India has traded at a premium, and I think that is justifiable.
Okay. But one thing is changing in the Indian landscape right now is the contribution of the IT sector in the overall index performance, or as well as the GDP performance for that matter. So do you think there's a long-term impact of the change in the IT landscape that we are witnessing right now?
I think it's still too early to tell. The early indications are that in the near term, AI will result in an increase in the total addressable market for Indian companies. The more important question, I suppose, and the question which is harder to answer, is what will be the longer term impact? Will it reduce the TAM over an extended period of time? I think that's still very early to tell. But I think companies will also adapt and adopt to the new environment. They also realize that AI is an opportunity as well as a threat. So I think work which is very mundane in nature, work which is run the business kind of work, I think that work will certainly get commoditized. That work will certainly become AI irrelevant in a way. And I think companies will have to adapt and shift to other types of work. So this is not the first time that the Indian IT industry has seen massive change. The Indian IT industry got created because of Y2K. So there was an argument that could have been made that post Y2K, what's the reason for Indian IT companies to exist? But yet we adapted and we came out with a different business model. Then we had digital, then we had cloud and so on. So I think you need disruption every once in a while to create opportunities. It will create risks. It will wipe out some companies for sure, but we'll have to tell. In the near term, though, however, there is no risk that we see, but in the medium to long term, we'll have to see and evaluate how companies are adapting to the new AI landscape.
So I was reading a data point where back in 1990s, Amazon and Infosys had a similar R&D expenditure. But then in the last 20 years, Amazon R&D expenditure has grown multiple times. But Infosys R&D expenditure did not grow. Some people say that it is one of the reasons why, we have not been able to, adopt faster or make things or, progress faster. Do you think, we lag somewhere in the R&D expenditure aspect, especially in the IT domain?
I don't think one can compare, Amazon and Google, etc., to Indian IT companies. I think they're different business models. I think one type of business model requires greater investment in infrastructure and R&D, and I think that's what those companies do. I think the Indian companies have done a remarkable job over the years of growing, of adapting, of all of that. And no, I don't think they are underinvested. But if there is a need, I think they have the capital. I think the great part about IT companies is that they are highly cash flow generative businesses. So they have the ability to pay out meaningful cash. And if they want to conserve that cash and invest in R&D, they have the management capability, and they have the cash wherewithal. So it will happen if it needs to happen. I'm not sure whether it needs to happen, but the businesses are quite different.
Correct. And sir, given the recent scenario, there are a lot of experts saying that the earnings for the Indian companies might get impacted for the next 2 quarters at least. So do you see that happening?
It will happen because, see, raw material prices, anything related to crude has moved up. Crude itself has moved up by 30-40%, and the underlying crude derivatives have also moved up in many cases by 30, 40, 50, and in some cases even more than that. So that does have an impact on earnings for sure. So we'll have to see how long the war lasts, but the impact will not be felt really in the fourth quarter because the war started on 28th of Feb, and most companies will have 1-2 months inventory in place.
Right.
So it won't impact the fourth quarter, but it will impact the first quarter. And the impact will be 2-3-fold. One will be the impact will be on RM. RM itself has moved up. You won't be able to pass on all of the RM, so there will be an impact on margins.
Right.
The second is, as you increase prices, there will be some impact on demand. That's both consumer demand and non-consumer demand. Both will get impacted to some extent. So I think both of these, now we'll have to see, does the war get over in the next 10 days, 15 days, 1 month, 2 months, 3 months? It's very, very hard to figure that out. But will there be an impact? Yes, there certainly will be. Now, whether it's going to be 2%, 5%, 10% will depend on how long this war lasts and how if the war gets over, how quickly capacities can come on stream once again and what shape and form that takes. But it will have anywhere from a 2 to 10% impact.
And also, do you think the macros will get impacted? Like there will be an inflationary pressure?
Of
will
course
the interest rates also move up?
In the past, we've seen many crises. We've seen a global financial crisis. We've seen Asian currency crisis. We've seen a COVID crisis. Now we are seeing a Middle Eastern crisis. I think it is always when that crisis event occurs, it is very difficult to look beyond it, right? Because you're so caught up on a day-to-day basis reading about it and trying to understand it. But 6 months later, 9 months later, depending on the nature of the crisis, we do move beyond it, right? COVID, one can argue, was the biggest crisis of our lives. And it had a global impact. Nobody was untouched. And yet we've moved beyond it, right? We've moved beyond the European crisis. We moved beyond the other crisis events as well. So we will move beyond this as well. So I think you have to look at things. This will also pass. We have to look at things on a normalized basis. But in the near term, yes, there is uncertainty and earnings will get impacted. There will be shakes. There will be corrections in the market. But you have to look at it from a 2-year basis, 3-year basis. We are investors hopefully for 5 years and 10 years. And over that period of time, it doesn't impact returns. So in some sense, this is a little bit of an opportunity. Now, it doesn't mean that we put all our money in at one point of time. But I think it's okay to trickle money in today. And then as and when the market responds and corrects possibly further, we should look to take that as a further opportunity.
If there's some investors who's investing, say, for example, 1 lakh rupee in the fund right now, our fund only for that matter, how would you suggest, like, what kind of allocation should you do?
See, so far for some time we found the market to be expensive, and so we suggested the best way to invest is through an SIP format.
Correct.
Now, for the first time, we are also saying besides SIPs, which should continue, one can now begin to look at lump sums as well. But I think it's important to keep in mind lump sums as well doesn't mean that you have the ability or put in only one lump sum. I think you should have the ability to put in 4 to 5 lump sums. So this is a good time to start. And then you wait. And if the market corrects further, then the second lump sum comes in. The market corrects even further beyond that, the third and the fourth and the fifth. That way you get to capture the entire downside of the market, not just at one particular point of time. Because it's very difficult to time the market. Exactly. It's very difficult to say when the market will bottom out. Will it be now, 10% lower, 15% lower? So that lump sum journey, we think, should get restarted, but it should be staggered.
Right. So if I had 1 lakh, maybe 20% at regular intervals is something I can do.
At corrections.
At corrections,
yes.
Correct. And sir, you spoke about, looking at a 3-year, 5-year horizon. Our fund has been, say, other Midcap fund has been in existence for, I think, about 17, 18 years now. The returns on a longer term basis are, fantastic. But somehow investors don't make the same kind of returns because of the entry and the exit points, that they have. So I always see the funds having a different returns altogether, and the investors who are participating in the fund not making the same kind of returns. Happened with Peter Lynch back in the US as well. So what kind of, suggestions would you have for the investors when they invest with, say, for example, a mid-cap fund or maybe a small-cap fund, which is a little, the cycle take time to, move.
So I don't think, it changes whether it's a mid-cap, small-cap, large-cap fund. I think it's equities in general which should have a certain approach. I think that approach should be a combination of 3 things. And if you follow these 3 things, you will have a great outcome. I think the first is one must invest on a regular basis, not just at particular points of time. That's one. Two, I think you supplement that regular investment with once in a while lump sum investment, which should ideally take place during tough times when the environment is challenging, when the news flow is discouraging, and so on.
Correct.
And that's when valuations tend to be particularly attractive. And I think the third part of it is to really hold it for an extended period of time. Hold your investments not for 1 year and 3 years. We still think 3 years is a reasonable period of time. 5 is long. I would say 3 to 5 is the minimum holding period, and long term should be 10 years and 15 years and thereabouts.
Right.
So if you hold for the long term, if you invest regularly, and if you invest in market corrections, there's no reason why you shouldn't have a fantastic outcome. But the reality is most of us don't invest regularly. Most of us invest at the top, not at the bottom. In fact, some people remove at the bottom, and we don't invest for 10 years at a time. We invest at 1, 3, 5 years at a time. So the way we are investing, I think, is fundamentally something that should change.
Correct. And so when you're managing a fund or when you're looking at a fund, how do you generate ideas? Say, for example, in the mid-cap segment, how do you generate ideas that, this is a time when I should be switching to this sector or maybe this industry or this particular stock? How that idea generation comes into place?
So we have a fantastic team. I think, as the head of equities, we get a lot of attention. As fund managers, we get a lot of attention. But the people who don't get as much attention is our team of analysts. And we have a team of 12 analysts who are fantastic, who are incredibly knowledgeable and experienced. And we cover 480 odd companies. And our idea generation obviously comes from that universe of 480 companies. We rate these companies as buys, holds, sells, etc. And that generates a lot of ideas. But the portfolios themselves are created on a bottom-up basis. So we look at individual ideas. Sometimes the fund manager generates the idea himself or herself. A lot of them come from our research team, and then we populate those ideas into the portfolio, and then we manage risk in terms of allocation to sectors, exposure to certain variables, and so on. So the portfolio management exercise is done at an aggregate basis in order to reduce risk, liquidity, etc. But the ideas and the portfolio creation is certainly done on a bottom-up basis.
So what is the bottom-up approach that you follow? Like, how do you, once you identify that you want to be reading this company, what kind of process do you follow or your team follows?
So we obviously meet our companies very regularly. So we meet managements on a regular basis. We will obviously do plant visits and company visits. We will try and understand the ecosystem around it. We'll try and understand regulation and competition and so on. We'll try and meet large investors, especially if they tend to be private equity investors, to understand their take on the business and their outlook. So I think once you put all of this together, you get a reasonable perspective on the company. We obviously do a lot of industry work. We do a lot of channel checks and things of that sort. So we get an industry perspective, we get a company perspective. When you put those two together, you see what is the outlook for growth, you see what is cash flow generation going to look like, etc. And then, of course, you see, what is that available at? Is it available at a price which we think is palatable? If it is, then it presents an opportunity, and we're happy to scale it.
Okay. And what about the exit strategies? Or say, for example, if some sector or some industry has played out very well after you selected it a couple of years ago. So how do you exit it? Because the fund size is big, and once you start exiting in a mid or a small cap, opportunity, it might bring in some drawdowns. So how do you manage that?
See, we sell under 3-4 situations. We sell when our target prices have been more than met. So not just when we hit our target prices, but let's say companies are trading at 30, 40, 50% premium to where we think fair value is, then we will begin to sell. And as the price moves up, we tend to accelerate our selling. So one is price-based selling, when our target prices have been achieved. The second is we aim to sell when things go wrong. Right. Okay. So we had a particular thesis, that thesis doesn't work out, and then we would like to exit because our perspective and view on the company has changed. Typically, that usually results in selling at a loss, and
Correct.
Some investments are bound to be sold in that fashion. And the third is when you like the company, but you tend to like something better. And if there is no cash in the portfolio, then you will switch from one idea to another idea. So I think these are the 3 scenarios under which you sell. Now, if your thesis has gone right, then selling typically has less of an impact cost, because there is still a lot of excitement and following for the company, and the volumes are there, and hence you can exit. If your thesis is wrong, then the prices obviously do correct, and then you have to sell either with a price impact or once prices have already corrected. And that's the reality of our business.
Okay. All right. And sir, in case, say, for example, you had to create an entire, mid-cap portfolio right now, right from scratch, how would you have gone about it, both at the fund level and also to some extent at your personal level as well? Say for example, if you were doing it.
I think our portfolio constantly evolves. So if we are to create it today, I'm assuming that our portfolio would look very similar to what it is today. Because if we didn't like the portfolio today, if there are stocks that we didn't like or sectors that we didn't like, then we would have exited either entirely or we'd be in the process of exiting. So I think our highest conviction ideas in the mid-cap sector, our highest conviction ideas in the small-cap segment are both reflected in the current portfolio. So I think this is how we would like our portfolios to be. So I don't think had we to start from scratch, we would do things different today with the same amount of money. We would have very similar portfolios.
Okay. So do you do cash allocations as well during times when the markets are highly valued?
So we do some cash allocation, but it's not. I think the range is a little bit tight in the sense that we have normally 0 to 10% cash.
Okay.
0 is when we are extremely excited, and 10 is when we are extremely nervous, and then it varies between those. It also gets impacted not only by a market view, but also by a stock specific view. So if you're exiting a particular company, then obviously the cash is coming up or vice versa. So a little bit is driven by what we're doing at a portfolio company specific level. And then on an aggregate, if you don't find valuations attractive, then that cash can vary anywhere from 0 to 10%.
So I'm assuming, sir, right now it is 0%.
No, I didn't. Right now we have somewhere in the middle. So again, I pointed out earlier, it's not. We have moved from an environment. So for a long time, for the last year and a half, 2 years, we've been very concerned and apprehensive on the market, and that's what we've communicated to investors. We are now moving from what is called a negative, not what is called, but what was a negative environment from a valuation standpoint, to what is a reasonable environment.
Right.
So, but I don't think we are still in a very attractive, cheap environment. Individual companies have got there, but the market in aggregate, mid-cap segment in total is not cheap, small-cap segment in total is not cheap. Are the individual companies within that which are attractive? Certainly they are. So compared to a year and a half ago when we had very few buy ideas and very many sell ideas, that situation is now reversing. The number of sell ideas is coming down, the number of buy ideas is going up. So I don't think we're at a point where we're gung-ho, thumping the table, this is rock bottom and therefore we should have 0%.
Right.
Nor are we at a point where we are incredibly concerned and we have 10%. So we are somewhere in the middle. And that is why our cash also reflects somewhere in the middle.
Correct. And sir, in 2018-19, there was a norm where SEBI, classified large caps, mid caps and small caps based on ranks. Suppose that the entire mid cap fund, entire size went to the companies which rank from 101 to 250. So do you think mid caps in general, because of this rule, will always be a little more expensive compared to small caps and large caps both?
I think so. I think the large cap universe, top 100 companies is roughly 65 odd % of total, let's say 70% of market cap roughly, a little bit less than that. And small caps and mid caps are the balance, almost equally divided. So it's roughly 67% and 17-18% respectively, mid cap and small cap. Large caps 100 companies, it's a wide enough universe, there's enough for liquidity. Mid cap 150 companies ranging from, depending on which point you look at, 30,000 crores to 100,000 crores. So it's a much narrower universe. So there is a lot more money chasing a fairly narrow universe, and hence I think that does result in valuations being more expensive than they otherwise ought to be. Small cap is a wide universe and it's again 17-18% of market cap. So in a sense, mid caps are underrepresented, small caps are overrepresented to some extent.
So how do we correct for this from an investment?
So we'll see how do we correct it. Well, one is of course at a regulatory level and at an industry level, we have to go back to how we define mid caps and small caps and see if we need to alter that at different points of time. So I think that's an exercise which is ongoing even now. Other than that, you have to choose the best that you can within the category. You have category constraints, but fortunately 65% of the fund has to be put in mid, 65% of the fund has to put into small. So we have to balance 35 to play with the other segments. So you can choose to be in mid cap and more so in mid cap, or mid cap small cap, mid cap large cap. So you have options. So there is some flexibility which we get because of the 65%.
So a lot of times, I'm very sure in your past experience, you might have gotten a lot of right calls, but just the timing would have been wrong. Say, for example, you thought of a sector that will do well in 2024, but it starts doing well in 2026. So how do you try to tackle those kind of situations and get timing a little better than, what what you had?
I don't think it's easy to time these things, right? It's not easy to time sectors. It's not easy to time stocks. But fortunately, you look at our portfolio turnover, it's 10-12%, which
Okay.
means we are holding companies on average for, 7 to 10 years. So getting it wrong by 6 months or a year, I don't think is a challenge. I think the challenge is when you come in 3 years too early and then have the patience to hold on for those 3 years. I think that tends to be a lot harder. But if you're 6 months early, a year and a half early, I think that's still fairly manageable.
And sir, when you create a portfolio, what kind of matrix do you see with regards to the portfolio that these numbers in my portfolio should look like this?
I mean, in an ideal scenario, you want companies which are growing in mid-teens. You also want companies which have the ability to generate return on equity, which is also somewhere in the mid-teens. And then companies which are at the same time available at sensible prices, right? So reasonable 13 to 15% plus growth, 13 to 15% plus ROEs, and then valuations which are sensible. Now, in a bull market, you will get the 13, 15 under most scenarios. But when the market is expensive, you don't get the valuations that you want. When the market is cheap, you get a surfeit of ideas, and the valuations are obviously in your favor. But ideally, we'd like to have a portfolio where the ROE is, like I said, 15-16%, growth is 15-16%, and valuations, when you compare to 10-year averages, are either at a discount or close to those averages, or at even a little bit of a premium is fine. But we don't want to obviously buy companies which are at a dramatic premium to their long-term average.
Correct.
Unless the situation and the company has changed.
So what kind of investing is this, sir? Quality investing, growth investing, to some extent, it's value investing?
I think 90% of investors in India do GARP, right?
Okay.
Or I think there is a combination of GARP and growth. I think true value, deep value investing is a very difficult process, and it requires very, very long-term thinking.
Correct.
It results in significant periods of underperformance and then rapid periods of outperformance.
Correct.
So I think true deep value investing and having a large portion of your portfolio in value, I think doesn't exist so much in India. So then it comes to growth at a reasonable price or growth, where the valuations sometimes are less important. So it's a combination of those two, I think, for most people in the market. I think we are a little bit more growth at a reasonable price, or at least I am. I tend to give valuations a lot of emphasis, and that varies from person to person. Again, it's important to recognize there is no right way. It is not that growth is good and value is bad or GARP is bad. It is what suits that particular fund manager and investor. So an investor who has an inclination to growth, is a good growth investor, should do growth investing. Somebody who's more value oriented should invest in that fashion. I think trying to make a value investor into a growth investor, or a growth investor into a value investor, I think that's when the problems arise.
Right.
So we are certainly more growth at a reasonable price. Our growth is still, like I said, we're looking for mid-teens growth and mid-teens ROE. So we're not at the deep value part of the chain, but we're certainly not at the high end of growth and high end of valuation part of the chain. We have a little bit here, we have a little bit there, but when you aggregate it together and you look at the portfolio numbers, you will see this is much more of a GARP portfolio.
Okay.
It's got enough of growth, it's got enough of ROE, it's also got a focus on valuations.
And sir, I'm very sure there are phases when GARP does really well in the markets, growth style does really well in the markets, and there are also phases where value or quality does really well in the market. So how do you protect yourself from not getting inclined towards that other theme that is doing well and shifting to that theme for that?
I don't think you can, I don't think we can alter our styles depending on what the market wants. I don't think you can be, today I'll be growth because growth is working, tomorrow I'll be value because value is working, day after I'll be something else because that is working.
Correct.
I think you have to stick with what you understand, what you feel is the right approach, and then and hold on to that belief and create a portfolio on that basis. Because I think switching from one bucket into another bucket and trying to time it is what causes the problems.
Correct.
Which means sometimes you'll be investing in a style which is not appreciated by the market, and that will result in a period of underperformance. But are you supposed to at that point abandon your belief system and then chase something which is working? Some people try and do that. I think that's quite challenging. We certainly don't. I certainly don't. And then you have to struggle and suffer that underperformance. And we're all going to go through periods of underperformance. I think the endeavor is that when we underperform, we try and underperform less. And if you can, in bad times, not have very bad times, but in good times, have very good times,
right,
then overall, on a longer term basis, you will end up with a good outcome.
Got it. And sir, like what kind of, when you say GARP investing, what kind of sectors do you see, having this kind of allocation right now? Or sectors you're looking at or you're bullish at?
I think, this is not a sector uniform call. There are within sectors that we don't like, companies that we like, and vice versa. There are sectors that we don't like and companies that we like. So I don't think this is about sector investing. This is much more about stock specific investing, and that's the approach that we follow. So I think most sectors would fall into GAP, right? Whether it is pharma, whether it is IT, and of course, at different points of time, sectors are categorized in a different way. There was a point of time that IT was considered to be growth, then value, then growth. Same thing with pharma. So it does go back and forth. So even the definitions are not static. What is growth today can be value tomorrow, and so on. I think the key, like I said, is you have to know your style. I think you have to know yourself as an individual, and then invest according to those beliefs and not try and change those beliefs because they're working or not working at a particular point.
Got it. And so there have been a lot of talks about, India have been an exporter of services, but it's really important for us to, develop supply chains for the entire globe and have some kind of supply chain being developed on the manufacturing side as well. Do you think that will be super important for India to grow further and hence the markets to grow further from it?
I think it will be. I think you need a balanced economy, right? You cannot have an agri-driven economy only. You cannot have a services-only driven economy or highly dependent on services economy. Manufacturing is a large source of employment of blue-collar workers. So can you have emerging in India doing well without having a strong manufacturing footprint in existing areas plus in new areas? No, you can't. So you need a little bit of that for sure. Services is where we have a head start and we should double down and build up on that. But I think manufacturing certainly is, we've done very well in certain areas. We've done very well in auto components as an example. I think we can spread that into other areas as well. We have the advantage of cheap labor. We have the advantage of fantastic management. We have the disadvantage of poor infrastructure. So I think if we focus on infrastructure, focus on regulation, labor laws and things of that sort, and focus on giving incentives to the right sectors at the right point of time, I think manufacturing can certainly grow. But I think you have to look at it very holistically, and it has to have obviously support from state and national government as well. But manufacturing is absolutely imperative, without a doubt.
But can the supply chains, globally shift from China to India to some extent, or that is a far
In some areas it can, right? Because there is certainly a need to diversify away from China. We've seen that partly when COVID happened. We've seen that because of political reasons. So, the advantage of India is we are not only a good source from an outsourcing standpoint, good a market to look at from an outsourcing standpoint, but it's also a good domestic market because it's a large market to sell into. So I think some supply chains will shift, but it takes time, right? Because large supply chains have already been built in China and in other countries. So it's not that it can happen overnight, but it can happen slowly over a period of time. So in certain areas, it will happen, but not in all areas, certainly.
And how important are trade deals, for this to happen? For example, textiles is a little bit, beneficiary of the entire India-European Union deal that happened. So such kind of deals, how are they important for us to,
I think it's an important ingredient, but it is not the ingredient which makes or breaks the cake. Because for any company, the outlook will depend partly on how the domestic market does, partly how export does, which is impacted by trade deals. It's impacted by regulation. It's impacted by competition. It's impacted by raw material prices. So companies are complex beings. They get impacted. There are lots of pulls, lots of pushes, lots of variables. So amongst all the variables, tariffs and trade deals is one variable. So if that's something which is a headwind, then you have a little bit harder time moving forward. If it's a tailwind, you find it a little bit easier to move forward. But imagine you could have fantastic trade deals for a raw material environment which is very challenging, and then you're stuck. Or vice versa. You could have a challenging trade environment, but you could have fantastic, benign raw material prices or benign regulation or what have you. So I think the point is there is no one or two variables which is going to make or break a company. There are several things which take place simultaneously: domestic growth, external growth, etc., etc. So I think pinpointing one variable and saying that this is the fulcrum, I think that's not the way to look at it.
Okay. And is the adoption of AI is a headwind for us or a tailwind for us? Because India has been a net consumer of AI, and the contribution towards supplying, maybe in the entire supply chain of AI development, we are participating lesser. So do you think it is a headwind or a tailwind?
Again, first of all, I think it's very difficult to say how AI is going to evolve, right? It's still very, very early days. There's massive investment which is happening. One can argue there is over investment which is happening. There are some sectors which will benefit. There are other sectors which will not benefit. Companies within sectors which will benefit. There'll be early adopters and those who aren't. And sectors which will get hurt. There will be those who will adapt and those who won't. So I think it's very, very complex. I think what is fair to say is work which is very mundane, irregular, repeatable. I think that is being put to risk the most. But I think companies are aware of that and they're trying to do their best to move away from that kind of work into more value added work. So I think impact of AI, I think is very, very unclear what it is going to be on companies and sectors today. So we'll have to see. I think it's a little foolish to try and give a verdict this early.
Okay. And sir, one last thing. One piece of advice that you would like to give to retail investors, who are panicking a little because of the drawdown that they're facing in their portfolios, in the indices.
See, I think, like I said, I think the key to investing is investing actually a very simple activity. You have to do it regularly. You have to supplement it with lump sum investing during tough times, and you've got to have a very long-term perspective. And we are doing exactly the opposite of that.
Correct.
So retail investors tend not to have a long-term horizon. They tend to have a short horizon. They tend not to invest systematically, though that is changing a little bit. And they certainly don't do lump sums at the right time. They get more aggressive when the market is up. They get less aggressive when the market is down. When it is up, there is more clarity. There's more good news. When it is down, there's less clarity. There is less good news. And I think that is a challenge. So as long as you invest regularly, if you're a 10-year investor and you every once in a while dip into the market during tough times, there is no reason you can't do well. So I think investors have to be a lot more mindful in the way in which they invest, much more independent in their thinking, less driven by herd mentality. And just if you do the basics, you don't have to make this overly complicated. Just do the basics day in, day out, and you should have a very rewarding outcome.
Okay, I think so. That was a very valid and a very insightful point about how retailers should go about their money and their investments. So thank you, sir. I think it was a wonderful, short and a great conversation having with you.